Hi, this is Randy Finney with Right Side of the Chart, and today is Friday, May 31st, 2019. All right, as we head into the last trading day of the month, I want to do an overview of trade ideas. I'll do market analysis day in, day out. I'll touch on that quick because that does affect, where the markets go, particularly when you're in a strong trend, whether it's a bullish trend or a sharp a correction mode. When the market's kind of walking up or grinding sideways, there can be a lot of disparity between performances in individual stocks and sectors. But during broad-based sell-offs, what happens is almost all sectors and most stocks tend to fall with it due to indexing. They're all being sold as money's coming out of mutual funds and ETFs, especially those index funds. Everything gets sold down. So at that point, I kind of hyper-focus on the markets because it's easy to trade, one vehicle, QQQ, let's say, than versus trying to game a bunch of other stocks. But there's always exceptions to that rule, and that's why I'm going to go over the trade ideas today. That's why I have Apple and Intel and not QQQ as an official trade. There's a reason for that. We had a QQQ short that was closed out recently, so I'm going to go over the individual trade ideas. I'll be a little bit all over the place as far as what we're covering because we have commodities, bonds, and stocks right now. So pretty much, gold I keep mentioning is an unofficial trade idea, an area I like for part of the asset allocation now. I'm waiting for that higher probability long-term sell signal, but I'll get to the charts of gold in a second. So that pretty much covers the gamut of different asset classes out there: stocks, bonds, cash really is one asset class, and commodities, and then gold. Let's look at the charts, and let me just do a quick recap from this morning to what's changed, what hasn't. So last night, as you guys probably know by now, Trump tweeted out that he was planning on imposing tariffs on Mexico, increasing tariffs starting out at 5% if they didn't do more to control the stem of the immigration through our borders. So the markets obviously didn't like that. It's whatever. I'm not even going to comment on that. I try to refrain from my political views. What's happened technically? Not a lot really. It's an ugly move down. But here we're at. I'm going to just extend this line. As I did the video yesterday, I told you the Qs are in a downtrend, and again, that's the reason the QQQ is not an official trade in a downtrend without any buy signals yet. A buy signal will come here. We've had a couple pullbacks to support. Those supports didn't hold, but we still need to get a buy signal break out of the wedge, and it's still possible that these divergences in the wedge, everything that's in place now, could be burned through. And the more we go down at this point, we're getting really close to that possibility. What happens is things tend to break. You hit a certain point during a correction, a healthy correction goes back, new set of buyers step in, and then the uptrend resumes. But if you hit a certain point, like we did last quarter of last year, the fourth quarter, you get a lot of margin calls are triggered. Selling begets more selling as you go down, hit stop levels. More people, or support levels break. More people sell, and that's what we saw last quarter. And again, it was to be expected. I talked about it coming at the time due to institutions being too heavily into the FANG stocks, pension funds, I should say, and just most institutional investors being too heavy into the market in general, based on where we were, and so that was no surprise back then. I don't think we're going to hit that right now, but we can, and that's what I want to just say, make it clear that it's possible, but I don't think so. As of now, here's the wedge. That's all we did is just extend that line. Divergence lines didn't even have to be extended yet. It hasn't changed anything on the indicator. So let's see how we close the day. I guess that's the end of the point here. There's still very much the potential for the rally here, and if we don't break out today, then maybe this happens next week. We could possibly, it depends what happens today. If we do reverse and then we get a ramp into the close today, QQQ even has the potential to close the week green. We're not down that much for the week. We closed on Friday. There was, right, that candle closed at 178.16. So It would take a pretty sharp rally into the close today, but that would be what, less than 2%. We've all seen the market recover 2% before in a day, so there's a possibility. I wanted to point out that that would give us a green weekly close if we close above or on or above Friday's. Oh, we need to close above it. Friday's close there. Keep in mind, we also, as I mentioned before, we hit the 200-day exponential moving average on SPY the other day, but we never hit it on QQQ, and today we did. And that's a big level. I always like that level. I like it better on QQQ. Let me see if I can show you something. Okay, here it is. This is a weekly chart, 10-year weekly chart, and it shows you when you're using a weekly chart, just set a 40-week exponential moving average. If you want to use a simple moving average, that's fine. A lot of traders go off the simple moving averages. I happen to prefer the EMA, especially on tech stocks and QQQ. But what I wanted to show you is, during an uptrend. Now again, you can slice through it, but it's the initial. When I say the initial tag from above, I'm not talking the first. You get tagged all along. There's no initial tag. I mean the first tag in a while. If you haven't touched that level in several weeks or months, and it's that initial tag from above, which usually produces a reaction. We had one there. We undercut it there for a week or two, but it held. See, it holds. Look at all these reactions. Perfect kisses of it during the uptrend. And when you see the skinny part, if you're new to trading or investing, candlesticks, you have the fat part's called the body. The skinny part's called the down. When it's down below, you can call it the tail. And if it's above, they call it the wick. It's also known as a shadow on either side. So those are shadows, the skinny part there. And that just means you pierced it intra-week, but you held it on a weekly closing basis. So now, when you correct, yeah, you're going down through it. During corrections, a bear markets, you're going to be trading below the 200-day most of the time. And then what you want to look for, and we don't even have a bear market. This is 10 years, so it's not showing you the last bear market. You want to look for rallies back to it. So again, just look at all these instances just in the last couple years here. Let me clean these arrows out, where you kissed it and rallied. So now, do I think it holds ultimately? No. I think that level will go at some point soon, but it's the initial tag during these correction phases. Look at these perfect tags of that thing. And if you bought each instance, you would have been good. Now we had a tag there. Now this was the beginning of a much larger drop. And if I recall correctly, back then I wasn't involved at all interested in gaming the bounce back, pull back to the 200. We were short, and I believe we stayed short. It was the bounce back to it where I was interested in adding back shorts, recycling. And now look, we could slice through it like back then, but this is a pretty strong drop right to it. Again, the 40-week is the same as the 200 because there are 5 days in a week, so therefore you divide 200 by 5, that's where you get 40, if you're wondering where that number came from. That's it. So we don't have to bounce, and like I said, what makes me not want to go all in long like you would in a bull market, and go into some swing or trend positions is this. Like I said, the weekly charts are looking very ugly to me, but for the near term, I'm still favoring a bounce, and I know it doesn't look any better this morning than it did yesterday at the close with that big drop in the futures last night. But there it is, our first kiss of the 200-day moving average since we first broke back above it here. And we broke back above it. You can see what happened. Well, we ran into it, failed, couldn't get above it, finally broke out right here, back tested again, and then off to the races. So that's one level to watch. It would be better. I would much prefer if that 200-day lined up with price support, and that's concerning right there too. And this is another reason we're not long right now. QQQ is an official trade. The fact that we're down below price support, but that's that. Let's not spend too much more time on that. One quick thing, when market volatility spikes like this, the amount of the questions go up exponential on the site. And I'm glancing the trading room. I just want to say this. You guys know, when in normal market conditions, I have all the time in the world to give detailed chart analysis, detailed replies to questions regarding trading, just anything out there. When things get busy, somebody asked today in the trading room, and I'll try to get to it. Randy, can you give me a chart of SQQQ levels? Let me say this real quick. Normally, no problem. But there's two things to that. Number one, I always chart. You will never, rarely, I should say, rarely see me chart the 3-time leverage ETFs. I prefer to use the 1-time. Even if I'm trading a 3-time leveraged ETF, I like the 1-time because it shows the true picture, the technical picture. You look at QQQ, you can go back 20 years and it's going to mirror the NDX, the index that it tracks. There's no decay. You get to the leverage ETFs over time. The longer you go back in time, the more decay. And the more volatile a sector is, the worse that decay is. And therefore, you get a very distorted chart picture if you're trading, let's say, LABU or LABD. Those are the 3-time biotech ETFs. They track the same sector that XBI does. Pull up two charts, 10-year charts of XBI and then LABU and LABD, and you will see that they do not look the same. And that's why. Now, the point is this. On SQQQ, if I had time, I would do the chart, but I don't. Here's what I have to do, and you guys can do this if you're trading the 3-time ETFs. I'm going to go to a 60-minute chart here. So I've posted this chart quite a bit lately, QQQ, with some potential bounce targets if we rally. And for me to mark up the same levels on SQQ, it's easy to do, but it takes time that I don't have right now. You just go like this. Let's look at these reactions. So I can see a reaction there. I see a gap. I see a big gap right here that defines these two levels. So SQQQ, the 3-time short, is just going to be that same thing in reverse. Instead of a bullish falling wedge, you're going to have a downtrend line there, trend line there, and you're going to have the same gaps that QQQ does, because even though we have decay here, it's not too bad in the short term. You just have to pull both charts up and put them side by side or whatever, and then you can replicate the same levels that way. So again, time permitting, I'm glad to do this and send these out. I just want to show you guys how to do this until I can catch up on all the questions and comments coming in. Not to mention we had some technical issues on the site yesterday. I was working with a programmer on that, which I believe we have resolved. Let me know if you guys have any questions accessing any or issues accessing any part of the site now. All right, back to the markets, and then I'm going to move on to the individual trade ideas. NQ E-minis 60-minute chart. Again, same story as QQQ. We're in a downtrend. And as I said yesterday, that we could continue to work our way down, and we did. So the wedge line moved up a little, and that also brings the apex of the wedge a little farther down too. So we don't have to be, I always say this, on a wedge, you have a downtrend line, which is the most important level. That's the point you want to look for a breakout to go long. The lower line is simply a divergence line. It's not really a trend line. What I mean by that? Well, in my book, at least, a trend line needs to have a minimum of 3 reactions to make it valid, because any 2 points can be connected at random. So I on a wedge, to me at least, this is just a divergence line. Some people want to see 3 touches on the lower line on a falling wedge, but I'll just look at that for divergence. And again, that line, because you're in a downtrend, as long as you continue in a downtrend, until unless this potentially bullish setup dissipates, and that's all it is, a potentially bullish setup. If it breaks out, then you have a bullish chart pattern that's triggered an objective entry. But so as long as the divergences are intact and all that, there's still a chance that this can play out for a rally. And same thing on ES. I think I already put up these charts this morning. There it is. So I haven't even had to move that line since this morning. We've, so far holding on it. All right, let's get to the trade ideas. Now, I spent all that time on the market because we don't have a lot of trade ideas. Still keeping it light. I told you I have a watch list a mile long of both long and shorts. I'm just not comfortable. My convictions on where the market's going in the near term isn't very strong. I'm still leaning towards that bounce scenario, but guess what? If I'm wrong, I'm going to be really wrong, because we can hit that meltdown stage. So it's not safe like a normal market to go aggressively long, put a lot of longs on now, nor on the flip side is shorting very safe right now, because if we do get caught, Trump fires off another tweet in the other direction, the markets could explode to the upside, and that's what happens. The farther you get stretched, the more oversold. There's a rubber band. Think of a rubber band being stretched. The more you stretch it, the sharper it's going to snap back. Now, if you stretch too far, and I like to add to that analogy, rubber band can break, and that's what happened here. It got stretched, finally it snapped right there. Those are forced margin calls from longs, capitulation from those that might not have had forced margin calls, but just couldn't take the losses anymore, and that's when a rubber band can snap. So, or I mean break. I'm sorry, but here it snapped to the upside, there it snapped to the upside, and these are fast. And again, so when I have a little more clarity or confidence on the near-term direction of the broad market, then I'll add some more trade ideas. Now, focusing on a lot of alternative asset classes, we're going to get to in a second, the commodities and all that. And I did have enough confidence the other day. Would I add it again today? Probably not, but I can tell you, and I've said this in the trading room again today, I want to reiterate, especially to the silver members that don't have access to the trading room, nothing has changed. I don't see enough in the charts for me to modify my trading plan. I'll tell you this, I've done this a long time. The markets, every little zig and zag, rip and dip against your position, whatever you're trading, will often make you second guess everything. Market drops today, this market's never going to go up, it's going to drop forever. That tends to be most people's mindset. If something very significantly changed in the charts that I saw, I would, and I have occasionally, I don't do it often, but I would pull a trade early. That means modify my trading plan. But as of now, I don't see enough in the charts to change the trading plan for this one. We're going to go through these trade ideas now. Apple, these are my targets. And maybe, if this trade starts to pan out, there's a good chance I may close it early. That's usually what I do. Sometimes I will extend stops on trades. I'll modify a stop. Sometimes I'll raise it. Sometimes I'll lower it. And sometimes I'll just pull a trade altogether. I'll say, I'm closing this trade out. I don't like what I see. Wherever we're at, whether it's profitable at that point or not. But at this point in time, I see a nice, clean, bullish falling wedge. I see a stock that's holding up very well today, despite the market. Apple is up or down only 0.3 or about 1/3% right now. And that's pretty good. And more importantly, I like the fact this stock is holding that support, 175.51. You can see it's not just an arbitrary line. There's quite a few reactions. There's a big gap right here, reaction high, several reaction highs there. We gapped above it, and we didn't just kind of meander around when we gapped above it. What happened? It was resistance that Apple was tapping on. When they broke out, the stock ran. That tells me that is a technically significant level right there. And so now we have one of the biggest the biggest correction all year, hands down. But that's the thing about a correction during a larger downtrend, if that's what this is. As big as that is, and as what is that drop in percentage terms? I measured it out the other day. This is roughly not 20% yet, but close, getting close. As big as that is, here's what happens when a stock breaks this. So, if you think that Apple is oversold and can't go down anymore, just again, visit that. But as of now, it is at support, and the 60-minute chart still looks good. It's oversold on the daily here, and that's turning up. So I just wanted to state that. If you're in it, you do your own thing. These are just suggestions. These are levels that I like, and I are in my trading plan. You guys can certainly, and I know some people do take, if you like the trade, you have different stops, maybe a higher stop, maybe even a lower stop, and or different price targets. So Apple looks good for now. Like I said, broke out of the wedge, but it's not going anywhere because the market's not going anywhere. And Apple will have a very hard time, if not an impossible time, hitting these targets if the stock market, if QQQ cannot rally. It's as simple as that, and that's why I spent so much time on the market to begin with, because Apple is a top component. And it's going to go with the Qs. Intel, same story. I still very much like this trade. I like the fact it's held that $43 support. I've since in the middle of last year even. This goes back to well before the top. I was expecting Apple to fall down to that 43-ish level. Here on my weekly, I have 42.95 right here. I was tracking this wedge. And I outlined a scenario, and I still think it's going to do this, is to hit that first target, have a bounce. I didn't think the bounce would go that high, but it did, and then come on down here to my next target, about 38.27. But at this point, that's support. It's where support was before. I'm not looking for a big bounce this time around. I'm looking for a little bounce and then a move back down there. As of now, still looks good because it's held above that $43 support. You can see I have my stop a little bit below that, but it's run into this resistance. This was which I should label R1, you can see the levels here. Sometimes I'll put the actual level just so you can see how I do the adjustments to the price targets. So this number is the actual level of the line. This is a target set just slightly below that level. Earlier targets I'll come in a little more aggressively. The final targets I might set those stops a little, or the targets a little more below that, and that's that. So just like QQQ has to pop that trend line that I told you, if QQQ can break above the wedge, I have all the confidence that Intel will break that 44.75. That was my first resistance level, and we've hit it multiple times now, and that's what's capping the advances. And again, it's also the fact Intel is also a top component of QQQ, so it looks like it wants to rally, but guess what? Market doesn't always give you what you want. It's going to need some help from the Qs, and if Qs can rally, then Intel can rally too. So I like those two, and at least as of today, this one's also only down about a third of a percent. So we're outperforming QQQ. At least it shows this is stock selection. The market continues to fall, but Apple and Intel have stopped falling, at least for now. That doesn't mean they can't break those supports, but it's showing relative strength against the market, and that's why I don't have the convictions for a long on QQQ. But those two, met the criteria for an official trade. All right, next up. Since it's kind of related, Treasury bonds typically have an inverse correlation with the stock market, meaning one goes up, the other goes down. The basis for the TBT trade, which is TBT is just a 2 times short TLT, is that it hit my targets that I've had now since last year, actually. Move up here to that 128.56 level and or that downtrend line. Now, sometimes a security, including TBT, will overshoot a resistance level. I'm suspecting that's what this is. This is a very well-defined level. A lot of reactions on this line, on or around it, but you can see there's some reactions, meaning it acts as support or resistance. And so I believe this to be a momentum-fueled overshoot, and I'm either going to be right or wrong, and I want to say this, it will probably most likely depend on what the stock market does. If the market snaps, if that rubber band breaks and we flush down, we have another 5, 7, 10% downside in the equity markets before we have a decent bounce, well, TLT is a flight to safety instrument, and this will continue up, and then we have a breakout above support, and then the TBT trade gets stopped out. It's as simple as that. Never put all your eggs in one basket. That's the trade ideas that I have on the site are very far from an inclusive, all-encompassing portfolio. They're just trade ideas that stand out, supplement your own trading if you want to, you take them, or just for educational purposes you want to watch. But I also try to convey my thoughts. For example, in 401ks, I've been bullish treasuries since last fall and long that, and that's where my 401k money went before the big drop in the fourth quarter, and then again recently, until just recently. I've started scaling out, haven't taken everything out of there. There's just not a lot of money in 401ks. You can't really short most of them, and so therefore cash is usually the best option. Treasury bonds, and I think when we get a high probability bounce that might be 10% or more for the markets, when that time comes, I'll mention, and maybe you can make a tactical trade in S&P 500 index fund or something in a longer term account. But as of now, that's it. So did we get? Yep, we hit our stop. Oh no, not yet. Daily close. So this trade will either happen today or not. And so what I mean by that is either the Qs are going to rally at some point into the close today, recoup some or possibly all of today's losses. And if so, you'll probably see a quick reversal in treasuries with money coming out of treasuries. It could also happen next week. And if it does, I'm not modifying the stop. There's not enough in this. Oh, that's TLT. There's not enough in the charts right now. My convictions aren't as high enough for a bounce for me to modify this trading plan. So if they close below 30 today, meaning 29.99 or lower, that I'll take that trade off, and it's up to you if you want to leave it on, and see what happens next week. But as of now, that's still an active trade. And then we have a couple more active trades. Let's do wheat. That was one of the first commodities, ag commodities we added recently. Um, looking good here. We hit T1, hit T2, and there's still the third target up there. And there's going to be corrections along the way, just like coffee. I talked about that, but I still like this one. In fact, I want to show you the long-term charts on wheat. Okay, I posted this chart. I've posted this many times over the last year or so, or several years. This is my longest term. This is a 20-something year chart on wheat. These are wheat futures. What that means, continuous contract. They just splice futures. Have expiration dates. They roll over, so they just splice all the futures contracts together, and that's what they call the continuous contract. So this is what the ETN WEAT will track our wheat futures. And what I wanted to do here is, and I've said this before, that this is a long-term trade as well as a swing trade. This is a multi-decade uptrend line. Doesn't get any better than that. You're looking going back to the 90s here, late 90s right here, 1999. There's that trend line, and one would have done very well buying wheat on pullbacks to the trend line. Doesn't guarantee that trend line can't break, but what I like to see, you can see my little notes down here, overbought. So when you get pullbacks to that trend line and you're oversold, that is a dip below 30 on the RSI here, or just any of the oversold readings, I should say. That one didn't even hit the trend line. That's what I've measured out here. So let me change the color on this real quick for you, so you can see this a little better. Okay, so these measurements right here, you can see the circles on the oversold readings on the RSI, 52% rally, 45% rally, 36, 46, and so far only 25. So what I'm getting at here, this was a double tap oversold reading too. That's what I call two oversold readings in close proximity. I call it a double tap, all the better. And we've only gone up quote unquote, about 25%. I might have had that line a little high there. Maybe that's overestimating a little bit. So we're not even 25%. Again, you go back decades. The smallest rally that we had on following an oversold reading was 36%, and the biggest here was 52. Actually, really, if you bought at that point, the rally didn't end to right here, and that's a couple 100%, at least in the several 100%. And you can see here these divergences as well we look at. So I just want to kind of share my thoughts, and this is why I think there's more upside, and I'm willing to ride out, and why that's also not just a swing trade, it's also a long-term trade, which is aka trend trade. So if you're willing to ride out the zigs and zags, there's probably more in wheat, plenty more to come. Ditto for Joe. I mean, these ag commodities are running, and they're coming off a vicious bear market. And if there's one thing that I can impress, well, besides the fact, let me say this, because sometimes I talk on the upside potential. I think people get blinders and tunnel vision. I can and will be wrong, and that's the only guarantee I'll ever give you in trading. And also that even the best looking chart patterns don't play out. Now, with that being said, so therefore, use stops, don't get married to a trade. The other thing I want to add is do not ever underestimate how much, especially coffee, but some of these ag commodities, how much they can rally. Overbought can become much more overbought. Think of it like Bitcoin. When people thought, oh, Bitcoin can't continue to go up, it's already gone up, blah blah blah. Now they're not going to move up as much as Bitcoin, but this is just a bear market rally, 31%. But so far, coffee has jumped up just in the past, what was it, 7 days? I measured it on futures. It was about 16% in just the last trading sessions up until yesterday's highs. So, and I also think that there's plenty more to go. That's why I have such high targets here. So we nailed the entry. It looks good. There are going to be pullbacks along the way, just like wheat. In fact, this is the first pullback that we've had so far since this thing started ripping. We had a little red candle there. And now let me show you the weekly chart, which I think is even more impressive. Okay, this is the weekly chart of coffee futures. Again, goes back to the late 90s. And you can see the bull and bear trends, and they are powerful. And you can see what I like to look for on coffee. It's pretty simple. Watch, rinse, repeat stuff. You just got to be patient. You got to let these things come to you. But Let's see, let me change this trend line here. Right here, you can see, okay, so we had a divergent low at this point. There's your bullish divergence. We had a nice downtrend line to watch. There was a breakout. These are trend changes, and these are big, powerful, many double digit, sometimes triple digit gains on these rallies. So I look for simply these divergent lows and divergent highs. And here you had a very extended run, divergent high, nice clean trend line there to short coffee. There's your divergent low. There's a positive divergence. There was a negative divergence right here. You can see the divergence lines. If it says divergent high or low, you'll have at least one, preferably two divergent lines. So right here, this is big divergence here on the PPO. There's our RSI divergent. There's the downtrend line. There's a breakout, and coffee's running. And again, if you think that, wow, 16%, I want to take profits. Take profits where you're comfortable, but I can tell you that I'm in this one for the long run. Let's try to put in perspective for you. I'm going to measure these runs from top to bottom. This run from that divergent low to that divergent high, that was a 300% rally in coffee. Pulled back here, and then it ran another 200%. This rally here off that divergent low into the divergent high was about 120%. So this 16% move to me, I think coffee is just getting started. Maybe I'm wrong. Again, that's why you don't get married to it. Keep your stops wherever you're comfortable with. At this point, maybe raise them to break even. But these were targets. I listed that 60, 90%. I listed back here. I've been tracking this for a while, and those numbers will probably, I'll tell you where they're at. From the low recently, if we get there now, that would be about let me get on it again. About 100%, 95% run if it gets there, and I think that can, and I think I had a pretty solid chance of getting at least up here. That's about a 62% gain. So hopefully that puts things in perspective, and also on how quick it can get there. Well, that all depends, but you can see this explosive rally, and we caught that one. We were long the bulk of that in JO back then. And the ETN did a very good job. I put up a post on that because I get a lot of feedback. Oh, those ETNs track horrible. Well, look, I like futures, but a lot of people don't have the money or the experience for futures contracts are fairly large size, a lot of leverage involved. But these ETNs do a pretty good job of tracking the commodities or ag commodities. Nat gas ETNs, not so much. There's a lot of decay and other things. But again, if you don't have futures contract, you have no other way to trade coffee directly other than the ETNs. So that's what we're using as the official trade idea. So that's that. Okay, the video's getting long. I'll just mention one more. I highlighted REMX the other day, rare earth metals ETF, and it's moving up. We had this divergent low, and I still think there's more upside. Some of the individual stocks are just flying, but they're low price. They're penny stocks. This one here, UCUV. 200 and something percent recently. What else do we have? This one's ripping VLNF right after look at a beautiful downtrend line break, and then about a 215% runs. I went over those in a video. I'm not going to spend time going over those now, but that's another op. And then there's gold. I've been stating gold, even though it's not an official trade. I've been saying that's part of where my longer term funds are right now. And there's a breakout today. It's a downtrend line that I had. It's catching a flight to safety bid, and the big move I'm waiting for, as you guys know, if you've watched my videos, I'm waiting for a breakout in the euro US dollar. I have these two downtrend lines. That yellow downtrend line would probably spark a rally and take us above there. Then we have price resistance. So I might add gold before that even breaks out. To me, this is inevitable. I see a major reversal in the dollar, a major trend reversal. That's not just a short-term tactical trade, more of a strategic, longer-term trade on gold. And I think the euro US dollar will rise in the coming months to years once this breaks out, and gold should do very well. And gold, starting to go already, because again, it has there's two components to gold. There's the demand, there's industrial demand. Let's put that aside. During times of market volatility, it's a flight to safety bid. Yes, we have Bitcoin now as an alternative currency, but gold is the gold standard. Gold going back, for thousands of years, has been a store of value, used as a proxy currency, and it will always continue to be, at least for the foreseeable future, or until it isn't. So, times of market volatility, people buy gold because they don't know where else to put their money. They want out of stocks. Bonds really have a pretty abysmal longer-term outlook, but right now the treasuries are doing well. And so that's that. Oh, and then the other component of gold is the fact that at least the gold here in the U.S., maybe you live somewhere else in the world, but we're trading GLD, or if you buy gold bars, they're based in U.S. Dollars, and so it's very simple. If the U.S. dollar drops 10% or whatever it drops, it takes more dollars to buy an ounce of gold. That's why when the dollar drops, gold goes up in price, and when the dollar rallies, gold goes down in price because it takes fewer dollars to buy it. So if you get the double whammy here of the dollar reversing, we get a downtrend in the U.S. dollar, breakout in the euro against the dollar, and the markets continue to drop. If we enter a bear market, I think gold will do very well going forward. So, and again, is it just because it's not an official trade, it makes sense for a piece of portfolio. Keep in mind, guys, before I wrap this up, I know this video has been long. If we do pop here soon, if this wedge breaks out next week or so, then you're probably going to see money come out of gold and treasuries as well, like I said. So that gold trade is not completely, dependent on what the stock market does, but to a pretty good extent it is. So that's that. Let's wrap it up here. Long video. Hope you found it useful. And like I said, if anything significantly changes in the charts, I'll let you know. And if you're new to trading or not new, you just don't like this volatility, you don't know what to do, stay out of the market. Keep your positions light. There's no reason to always be in the market. In fact, that's probably the biggest detriment I found early on as a trader, the urge to ABT, always be trading. If the charts aren't clear, just stand aside and wait for your setup. If you're wanting to go long and you haven't, wait for that breakout. It may happen on a gap up. I thought we were going to get a gap up today, but of course that didn't happen. We got the opposite. And that just shows you, anything can happen. All right, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.